Hey everyone, how you doing? Steve Peterson with Infinity Investments, and we thank you all for tuning in. And we got a really special guest. It's Richard Wilson, CEO of the Family Office Club, and he's been at this business. What is it 13 years, Richard, that you ran
Yep.
this company?
Yep. 13 years now.
Fantastic. Well, thank you for coming on, Richard. I mean, it's very rare that a CEO of your stature will come down here, kind of, feet to the street with a guy like me, and kind of mid-level real estate. So we really appreciate it. And a lot of our listeners are going to be small to mid-size, real estate investors. And so many of them don't know what a family office is. So can you, explain that for us? What exactly
Yeah,
is a family office?
sure. Yeah. A family office is really just an ultra wealthy investment solution. So if somebody is worth 5, 10, 20, $50 million or much more, they're going to invest differently than somebody who's worth $500,000 or $50,000. So they need more help. They need more tax planning. Sometimes they need multi-generational planning for their kids. It might need more legal protection and structures around what they're doing. And they're probably doing more sophisticated investing where they're going to invest directly into operating companies as well as real estate assets and not just through a fund or a sponsor. So that's the reason why the family office industry really exists.
Wow, and I only been in the business myself. I only heard about it a couple years ago, and since then, I've connected with you, learned a lot about it, and it seems to be if you're building wealth and you want to leave a legacy beyond it, that's the way to go. And do you see within the family office world a lot of people working with second, third generations? Is this something that really where everyone in the family gets involved, or at least certain generations, second, third, are involved, kind of in the investment business?
Yeah, some families more than others. Some families, there's a real goal to groom, the son or the daughter in the family to take over soon.
Yeah, yeah.
In other families, there's not much of an interest, or the kids are too young, or the kids have gone off their own directions and really have no interest. So it just depends on the family. And for people listening, a family office has nothing to do with having an office in your home.
Yeah,
It's really an ultra wealthy investment solution. I find
yeah.
confusion around that when people hear about the term for the first time.
Yeah. Well, especially now because, our homes have become offices, schools,
Right.
gyms. You know what I mean? It's an interesting
Yeah.
time. And so, my kids came up to my office the other day and we were, I was telling them about business and they were like, well, this is our office right here, and
Right. Right.
it's kind of exciting. So thank you for breaking that down for us. And
Sure.
with speaking of the pandemic and this crazy situation, how are you guys and your company and the industry and the family office industry as a whole maybe pivoting, during this time?
Yeah, sure. I think people are looking for subscription companies that haven't been hurt too bad or they are growing. They're looking for real estate deals that maybe the deal was supposed to close. Now maybe the bank requires more capital at the table, or maybe some investors got cold feet.
Yeah.
So maybe a new investor might come in on better terms, and basically get superior terms, reduced fees maybe, for being able to come in like that. I've also seen that sometimes investors are giving a small amount of equity in a deal just for standing in and signing on the recourse debt.
Mm.
They have to be pretty confident in the operator and confident in the asset, but they might
Wow.
get 5 to 20% equity by putting their balance sheet at risk, saying, hey, I would have to maybe operate or run this asset or make the bank whole if we broke some covenant or something. But a family might be able to pick up an equity stake without investing money that way. And I just feel like there's some companies now that are doing better than ever, and investors want to hear about that, but they also want to hear about where have things already been kind of dislodged, and pricing's already changed enough to the point where they can invest and get a better deal than they could a couple months ago. So there's a lot
Absolutely.
of talk around those ideas.
Absolutely. And you mentioned, you know, uh, doing deals where the bank got cold feet or investors, or bank changed things up or investors got cold feet. And as a broker in commercial real estate, been a lot of that, man. I mean, when the pandemic hit, I know there was 3 deals I was involved in, and where we nixed them because especially the buyers are just like, we don't know which way is up, and
Yeah.
I feel we were kind of at a point where people were paying top dollar before, so nobody really wants to pay top dollar during this kind of time. And it's great to know
Right.
that, but within adversity is always opportunity. And so you just mentioned a couple things such as a family office kind of just signing on a deal, getting a stake. And a lot of times that may be what it takes to get the deal closed, right? Because the banks want to
Right.
see more financial strength. And someone who was rock solid maybe a couple months ago might not be as rock solid depending on what their business is and what their industry. I know a lot of people who have had to lay off
Yeah.
a lot of employees, and so I know it's very interesting. So for you to say that, something that we've always talked about in terms of like partnering up, and so maybe somebody on a smaller level, somebody's got a good credit or somebody's got capital over here, so you can sign it off, and it's kind of that's an example of the pen being mightier than the sword in many ways. Just by having yourself established and having these family office, you can do a lot.
Right.
And so on that note, in terms of like putting deals together, raising capital, it's like it's like a rites of passage as an entrepreneur. Um, what are some of the key fundamentals? And I know in your business, you guys put a lot of capital together and make deals happen. What are some of the just basic fundamentals for people out there who want to raise capital for either their real estate or maybe their company?
Right. The biggest thing is to have a brand name that actually means something, as simple as that sounds. Everyone has brands like Wilson Capital or some Greek god capital, and no one knows if you're doing biotech or investing in consumer products or doing
Right,
real
right.
estate. So I would just stop choosing names that mean absolutely nothing. And then most people don't have a one-liner on exactly what they're investing in or what their firm does. And they have to go through a paragraph kind of explaining it, or their one-liner sounds like everyone else. They go, we're a commercial real estate broker in New York, or oh, we invest in apartment buildings that are workforce housing, or and it's like, well, 20,000 other people are saying that, so why should anyone care?
Yeah.
You really need a one-liner that cuts through all the noise and hits your ideal prospect between the eyes, like, oh, this is the group for me, because he's a commercial real estate broker that only deals in self-storage, or
Yeah.
this is
Yeah.
a investment firm that only invests in industrial and only in Austin, Texas. Maybe they really know what they're doing within that niche compared to all the other people that are reaching out to me. Maybe it's more interesting that way to a certain group of people. So getting that one-liner down sounds so simple. And we've got a whole book of ideas at capitalraising.com. It's free. There's like probably 50 strategies in there on how to raise capital. But those are two really basic ones that like almost everybody gets wrong, surprisingly.
Yeah, that's interesting. You mentioned about the name, the company name, and
Mm-hmm.
it does mean so much. And I think a lot of times people are just not throwing stuff against the wall or just doing something that
Right,
may sound sexy, but doesn't really have any tangible meaning or
right.
value to what they're doing. And so I think that was
Yeah,
a really important point. And then having your one-liner, 30-second pitch, having it down in a succinct way. That's a great point because especially I think in real estate there's so many different avenues of investment, right? So many different product
right.
types, so many ways of structuring a deal. So you got to kind of be able to get to the point real quick to where it's also an interesting story you have to tell within a short period of time. So that was great to hear you say that. Now talk about fundamentals. What are some of the high level aspects of raising capital? Because I know there's the basics, the
Sure.
blocking and tackling, right? And then there's
Yeah.
the exotic blitz scheme and audibles at the line you got to call, so to speak. So what are some of the high level things that you do and that you see that are successful?
Sure. One is to have different types of investment structures available. So you might have a fund or be an independent sponsor with a certain fee structure, but perhaps if somebody is willing to invest more money, then maybe they get a performance only fee structure. Or if you're raising capital
Okay.
for something, you might be able to have an option. Maybe you do have a fund, but maybe for a first time investor, you let them invest deal by deal. They get to trust you, but maybe they can only invest deal by deal for 2 deals, and then they have to come into the fund and they either trust you at that point to invest in the fund or not. Another strategy that is counterintuitive is a lot of people start really low minimums and they keep raising them and they try to say, oh, now I want to go after family office money and have a $500,000 minimum. But it could be a big mistake because if you have a
Hmm.
minimum of just $25,000 or $50,000, people can just use that as almost an extension of their due diligence process. they might spend $10,000 doing due diligence on you. And if they can just put $25,000 at risk, get to know you better that way, then maybe they could allocate the 100 or the 500 with much more ease rather than saying, well, I got to invest nothing or 500,000. And then it's a lot harder to get to know you and build the trust. And especially if you're doing 4 or more deals per year, then, get them in on the first one at 25,000 in a relatively short period of time. And then they could get them in at the much higher level later. If you're doing 1 deal per year, then yeah, it might be hard. You're really investing a couple of years to grow that investor up to a meaningful amount. But a lot of people just don't want to deal with that number of investors, but it's a
Yeah.
way to get momentum.
Well, that's a real interesting point because you said it, the nail on the head. A lot of people just want to get half a million, $1 million investors, the big money. A lot less management is the idea,
Right.
versus having a bunch of smaller investors. There's a guy I know and follow very well. His name is Jay Morrison, and he did a raised a tier 2 crowd fund. He raised over 10 million. I know his minimum investment was like $500. And I
Wow.
was really surprised. And he had a different approach to it. He's kind of like a black leader in the community, and
Sure.
used to be an activist, and well, it still is, but he's an entrepreneur. And what his idea was, if we could start with a small amount, a lot of management. So he's doing a lot of work, but he proved that at least that idea of, hey, a bunch of people put $500 at a minimum together, you could do
Right.
something major. So probably a lot of work that way, but I like what you said in terms of, hey, somebody puts up 25 grand, that's a way, like an extension of a due diligence, right? They're just kind of
Right.
really getting to know you. That's versus if they have to put up 500,000, that's a commitment at whatever capital level you are in
Right.
life, right?
Yeah,
So
for sure.
maybe and that's a great point, especially guys who are moving to the higher level. A lot of times they listen, I don't want to take the smaller money, and I see that a lot in real estate syndications where,
Right.
I think now, especially in a pivoting situation where I think maybe relationships are really important.
Right.
That makes a lot of sense. And within the world of family office, how do I know probably every office is different. A bunch of people have different strategies, but in general, like in terms of real estate, do most of the investors like to structure their deals all equity, some debt, a little bit of blend of equity and debt? What's the typical structure
Sure.
for investors coming in on real estate deals?
Typically it's 65 to 70% debt and the rest equity, but investors like to come in as debt or get an income component in a secured income offering. And many times they're not offered that, they're just offered an equity participation. But if there's a way to structure your deal to provide a 9%, to 12% income or a debt note to somebody, so they're getting a monthly or quarterly distribution, then
Yeah,
that can be superior sometimes to just offering somebody equity.
yeah.
And so, when possible, it's good to look out for that option.
That makes a lot of sense right there. And so you mentioned that 65% debt load, if you will, is what people would like to invest in. Now, I would imagine a lot of family offices don't want to do or don't want to invest in something that's too highly leveraged, right? We want to make
Right.
sure that there's a proper balance of equity, which is,
Right.
I think, I've been saying for a while, I think is very important. And when we went through the last market crash in real estate, I think a big part of it was just we were too highly leveraged,
Right.
and the properties were not inherently cash flowing because the
Right.
debt was just taken away. So I think that's, as we shift and as we pivot, an important part to putting deals together, raising capital, making things happen. Now with you guys, in terms of I know rates of return and everything, all that stuff. Everybody's going to have different criteria. Everybody's
Sure.
going to have different strategies. Different product types. Kind of like what I'm going to ask you. Product type. What are most people like? And then I'm going to ask about sponsors. What do people want to see out of sponsors? But product type. Most people,
Sure.
love apartment buildings.
Right.
We know hotels have been taking it on the chin. But what are some of the top food groups that folks in the family office world like to invest in?
Sure. Right now, I'm seeing a lot of interest in self-storage and industrial are the
Yeah.
two with the most interest, it seems. Some self-storage groups say that they're up 30%
Wow.
in revenue over the last year.
Wow.
Some of that same group, they've been improving their properties, et cetera, but they haven't taken a hit at all from the virus, and people are putting their stuff in storage as they don't renew their office leases that maybe happen to be ending this quarter. And they say, well,
Yeah.
now we can have an office. Might as
Yeah.
well just put it all in storage and save 20,000 a month or 5,000 a month, whatever. So I think that's helping. And then the internet is really driving the industrial
Yeah.
demand, or at least keeping that a bit more balanced out. So those two areas have been of more interest. And also, I think industrial and self storage were just not as overheated as multifamily.
Yeah. Yeah. Yeah.
But
Yeah.
anyway, in multifamily, there's so many opportunities that there'll be a percentage that are dislocated and need an investor, and there's a arbitrage opportunity. So, opportunities where the investor can feel comfortable and they trust the team and they trust the opportunity and they can get in and earn a good return of any asset type are always going to be in high demand. And what I found is that on the income side, the 9 to 11, 9 to 12% is the income level that people would like to have off of a secure piece of real estate. And then on the other side of things, when it comes to an equity investment, they're usually looking for like a 12 to 17% IRR.
Oh wow. Okay. Okay. So that's that's great news. So I mean, it's a lot of deals, may not. A lot of people think they need to, show crazy returns, 30% IRR, or something like that to attract people. So that's 12 to 17%, but I would imagine it's got to be a solid deal, solid operator,
Right.
and that's what I was going to ask next. What do investors want to see out of the sponsors? What do they want to see out of the operators, the folks putting the deal together? And I know that's an important part. Maybe they look at the deal first, but when it comes to looking at the guys making it happen, what are they looking for?
Yeah, I think the team and the quality of the team and the trust in the team is more important than the return to the deal.
Interesting.
So they want to
Interesting.
see a team that's committed, that's professional, they can answer questions, is transparent, they're aligned on their fees and their structures. They've got a unique strategy in the market compared to everyone else. Obviously, the opportunity has to be great as well, but people would rather invest with an excellent team on just a good or a great deal rather than an excellent deal and then just kind of an average team. Then usually a deal just won't get done. So I think that's what's most important.
And I hope people listening heard that. The trust of the team and who the team is oftentimes more important than the rates of return. So I mean that's huge, and I think that as we as entrepreneurs, and I've been saying a lot, my YouTube videos last month or so, is it's time to sharpen your axe. It's time to build yourself, who you are and your skill set and your leadership ability, and your team. And I think I really
Right.
believe that, regardless if you're raising capital, just building a business, that's important. So it's great to hear you say that even maybe more important than the rate of return.
Right.
So huge, man. And lastly, for the small, the mid-size real estate investors, and what I see with a lot of real estate investors is that we are ambitious people. A lot of people are independent, rogue individuals, but you hit a point a lot of times where you're at the end of your own capital. You got to go out there, and if but you're ambitious, you want to continue growing. You see the big boys and girls in the industry making moves. You're kind of here, but in order to go to that next level, probably got to start raising capital, or bringing on partners, or just figuring out how to do deals. What would be
Yeah.
your advice for that small to mid-sized real estate investor wanting to scale up and move to the next level in terms of putting capital and deals together?
Yeah, I would say avoid, daisy chain situations where you're not direct to something and you're like
Yeah.
3 steps away from what's actually happening. I think that hurts your credibility. Avoid going from not having raised capital before to trying to get a $50 million deal done or $100 million deal done.
Right, right, right.
It's better to keep it realistic and,
Yeah.
just knock out some singles and doubles, get some small deals done, get your processes down, build that track record of getting things down. People will trust you more investing 25K, 75K of their money than, "Oh, I've never raised capital before. And now you're trying to raise 750,000 per investor or, 7 million. on short notice, it's going to be tough, and it's going to be tough for multiple reasons. You won't know what to say. You're not going to know how to respond. The due diligence they're going to do on you, they're going to ask for references more and more so the higher the numbers are. So I would say don't swing too big too fast. And if you're not getting momentum, to niche down more. So if
Yeah,
you're
yeah,
raising capital for 5 different types of deals, people don't know what box to put you in or when to refer to you or where your expertise is. But if you're only working on self-storage only in San Diego, then it's easier to refer you to someone or keep you in mind or know what your expertise is. And it's easier to be credible as, hey, I'm one of the top 3 most knowledgeable people on self-storage in San Diego, because how many people are playing that game? So if you want access to self-storage in the area, I'm a guy who's doing a good job playing that game versus, oh, I do commercial real estate investments all over the West Coast in
right.
5 different asset classes. It's a bit tough.
Yeah, yeah. Jack of all trades is usually the master of nothing, right? And so,
Right.
special specialty, I think, is important. Something I talk about with my agents and my team is, telling them to focus on an area, focus on a product type, so you can dominate. And I'm glad to hear you say that. And that's jewels of wisdom for people who are wanting to scale up their business, uh, their real estate portfolio, whatever it is that they're doing. So, Richard, you do a lot of stuff online. You're very unique, man. Just because, like I said, a lot of guys at your level are not kind of feet to the street. With guys like me who are pounding the pavement. So,
Sure.
I think a lot of our people should be following you. What is the best way for folks to follow you and engage in what you're doing?
Sure. If you love podcasts, we've got our Family Office podcast, we have the Family Office Club channel on YouTube. We've got 350 videos there. If you want to be a member of the Family Office Club and check out what we're all about, you can go to familyoffices.com. It's familyoffices.com. And like I mentioned earlier, we've got a free book on capital raising at capitalraising.com. But I've just built my business based on improving myself through absorbing thought leadership. And then we've created our whole business by providing thought leadership. And now we've got our 16-person team and several $1 million of revenue coming in per year. And on both sides, it was because of thought leadership. So part of it is being helpful to others because others were helpful to me.
Yeah,
But also on the selfish level, it's what attracts to us our clients, members to the club, our deal flow, our
yeah,
investor clients. So it just works as a marketing model. I wouldn't do it only to improve mankind, but
of
luckily
course.
their strategy happens to be
Yeah,
something that really helps people because most people will get a ton of value and they might not do business with us, economically for 6 months or 6 years or 16 years, and that's fine. We're just playing the long game to add value like you do.
well, I mean, thank you for saying that, and I really appreciate that approach. I built my business that way, and I'm hoping to scale up and
Sure.
and learn from guys like you. So it's encouraging to hear you say that because it's like organic growth, but you're making millions of dollars of revenue doing it, and providing value to people who want to grow their business, and that's just amazing. I really appreciate you coming on. I look forward to staying in contact with you throughout the years. I'm certainly a subscriber to your YouTube station. I love you guys
Cool.
got the great content every week, man. So I encourage you all, subscribe to the station, go to his podcast, learn more about family offices, listen to this video because he just broke down some jewels of wisdom, guys, what it takes to really, in my opinion, be an entrepreneur, and how to engage with the capital world, so to speak, and do it in a professional and efficient manner. So, Richard, really appreciate it, man. Thanks so much,
Sure. Yeah.
and
Thanks for having me here.
much continued success.
Thank you. Take care,
All right,
Steve.
all right, man. Have a great one.
You too.
All
Bye.
right, bye.